please go to page 9. Yeah, we're looking at page 9 at the moment. So basically, guys, why I came to page 9 is this is what we call the financial statements. So page 9 is the objective of every company for processing the transaction. So basically the accounting cycle. So remember, it's transaction, then comes source documents, then comes books of first entry, then comes general ledger, there comes trial balance, and then the next step will be financial statements. So there is a page that will show you when we do learning unit 2. So in learning unit 2, you I will be covering. So in learning unit 2, it will show you what I'm talking about, the accounting cycle. So basically, on the accounting cycle, there's a part called financial statements. So this is the part that I'm talking about, to say that everything that we'll be recording, the end result will be this, will be the financial statements. So basically, the objective of financial statements is to provide information about the financial position, the financial performance, and cash flow of an entity that is useful to a wide range of users in making economic decisions. To meet that objective, financial statements need to provide information about an entity's assets, liabilities, equity, income, and expenses, and then cash flow. So what also I need to tell you about this is on the accounting cycle, we talk about transaction. After the transaction, there will come the source documents. After the source documents, it will be recording in the books of first entry, which also I think we'll cover later in the learning unit. General ledger, then trial balance. So whilst we're going through learning unit 1 and 2, please, if you feel I'm fast or you're lost or you're not sure where I am, please just write on the chat that you don't understand. So basically, what I want to show you here is assets. So assets, liabilities, equity. Assets, liabilities, equity. They are part of what? Your statement of financial position. Assets, liabilities, and equity are part of the financial position. What is the financial position of the company? And then your financial position is your profit and loss. So basically, this is your income. This is your income and expenses. This will reflect the financial position of the company. Then comes statement of financial position, which reflects movement in capital and current accounts. And then there comes the cash flow statement that a company needs to do. Then comes the notes to the financial statements. So basically, I'm coming to this last step because this is the overall objective of the company. So for you, as let's say you're an accountant of the company, at the end of the day, whilst you focusing on the accounting cycle, this is the end objective. This is where you need to go. This is where you need to be at the end of the day. You need to be here. You need to produce financial statements. You need to produce financial statements that has to be audited. So looking at this, can you see what I'm showing you now? This is the statement of financial position, statement of profit or loss. So after me showing you this, I want to show you, there's an example. An example I want to show you of how the financial statements look like. So this is the financial statements that I'm showing you. So what I just showed you now is I want to show you how the financial statements look like. So page 6, this is what they're explaining to you on page 6. So this is an example of Sasol Limited. So this is their financial statements. Can you see? Just go down. Let me just go down. I just want to show you the financial position, statement of financial performance, annual financial statements. Let's just go down. Directors report. So basically, this is the bigger picture of every company. This is where the end goal to see if are we making a profit. So basically, the financial performance is, are we making a profit or not? So the financial position is the statement of it's showing you as at the end of the financial position. Where is the company? Where what assets or liabilities at that date does the company have? What assets does the company own at that date, financial year end? So in this example of Sasol, can you see their year end? Their year end is June. So as of June, this is the income statement, the statement of comprehensive income. So this is the financial performance. This is the statement of financial performance. This one here is the statement of financial position. This is the statement of changes in equity. This is the cash flow. So this is an example of audited financial statements. Can you see that? This is what now in page 6. Page 6 of your learning unit 1. This is an example of that financial statements that was audited. So basically, for a company to get to that stage, they would have done the accounting cycle. So they would have done your so your accounting, on your accounting cycle, share this. So guys, can you see, and did you see now an example of financial statements, annual financial statements? So by the time the first step is done, there's a transaction that took place. Number 2, there's source documents. Number 3, there is entries that are recorded in books of first entry. Number 4, there is the general ledger. Number 5, the trial balance. The last step, which is the financial statements. Let me just, the last step would be your financial financial statements, which is in page 9. Page 9, 1.6. That's an example of what? Of your financial financial statement. Financial statements of the company. Then I want to go to page 11. I want to go to page 11. Page 11 of learning unit 1. So page 11, I want to look at the accounting. So at the bottom of page 11, they say there are 2 methods by which owner's equity can be calculated. So basically, this is the accounting equation. There is 2 methods of calculating the the accounting equation. So it's equity equals to assets minus liability. The next part is assets equals to equity plus liabilities. So basically, this is the accounting equation. This is the accounting equation. So I think the accounting equation will also go in detail on it in Learning Unit 2. And then let's go down. Expenses. So guys, I just wanna, before we move to Learning Unit 2, what for me, I want just to see if everybody understand what is income, what is an expense, what is asset, what is liability. So I'm gonna give you a scenario. So I want you, in this case, I want you um, to let me know on the chat if you understand what's an expense in a company, what's an income in a company, what's an asset in a company, what's a liability in a company. So I just want to see if everybody understand what by giving me examples. An example. So an example that I'm gonna give you is so there's a company called Walton's Stationers. Let me just give you this example. So the example, I'm going to give you this example. Just tell me what it, so if a company, for example, that company form of trading, what do they trade? What's the form of business? So the reason they've opened the business is they buy and sell stationery. That is the main form of business. So the name of the business is MM Stationers. So MM Stationers pays their employee, they've got an employee, they pay that employee 5,000 salary. So that employee will get a pay slip. So MM Stationers is a company, their form of business is buying and selling stationery. So one of the employees, they pay them a salary of 5,000 Rand per month. So my question to you is, what is that salary to MM Stationery, MM Stationers, the business? What is that 5,000 salary? Is it an asset? Is it an expense? Is it income? Is it a liability? I'm seeing responses here. I'm seeing responses here. Okay, I'm seeing responses. Okay, so offense is saying it's a salary. Salary is an expense. Slindile is saying wages and salary is an expense for the business. Non-Tanka is saying it is income. And then M Koza is saying it's an expense. Okay, Non-Tanka is saying that is income. So I'm gonna repeat that again. Okay, and then Amanda, yes, Amanda. So you said I must call you Amanda. Amanda saying it's an expense because there's money going out. Okay. And then Diron is saying expense. And then M Koza is saying expense. And then okay, so overall I can see everybody saying it's an expense. And then Non-Tanta is saying it's income. Lehlohonolo is also saying it's an expense. So Nonhlanhla is saying it's income. Nonhlanhla, why is it income? Just comment on the chat for us. Why is it income? Why Nonhlanhla, why is it income? So on page, we on page 13. Page 13 of Learning Unit 1. So it says expense are defined as a decreases in assets or increases in liabilities that result in the decrease in equity, other than those relating to Okay. No, I see you. I see. So you said you made a mistake. So so expenses are costs incurred by the business in order to run the business for the financial accounting period. So at the looks of things, everybody knows what's an expense. So well done, guys. Well done on that. Well done. I can see a comment there. So I'm gonna give you another example. Another example is MM Stationers. MM Stationers buys office equipment on credit from Game. So my question is, MM Stationers bought office equipment for the business on credit from Game. So that office equipment was gonna be used for the business. This is gonna be used for the business. So that office equipment, what is it to the business? Is it an asset? Is it a liability? Is it an expense? Is it income? So that office equipment, benze asset, mkhoza asset, Tyrone asset. It is an asset, yes. I'm impressed. Nonhlanhla asset, yes. Still okay. Asset, Google to asset, yes. Well done, yes. Google it is an asset. So I can see everybody's correct because office equipment was bought for the business. So the next question I'm having to you is, the next example is, now MM Stationers buys stationery to sell to their customers. So remember, the form of business is what? Is buying and selling stationery. So in this case, they are buying stationery to sell to their customers. What is that stationery? Is it asset? Is it liability? Is it an expense? What is it? What is it? Remember the form, what that business does determines how they're gonna record it. So I see Guguletu is saying asset, Lehlohonolo is saying inventory, and I think it's an asset because it will generate income. Asset. I think it's an asset. Amanda, yes, Nonhlanhla is an asset. Offense is an asset. Everybody is an asset. So what I like, I'm so impressed. Nobody here is saying it's an expense. Why station? Why, guys, are you not saying this is an expense? Because everybody's saying asset. Everybody's saying asset. Yes, I can see everybody saying asset. Because like Amanda said, it will generate money for the company. Okay. I think the asset because it will generate income for the business. Yes. So basically, yes, I agree with you guys. So basically, this is what? Stock. So when we do learning unit 3 tomorrow, we'll remember this. So when we do inventory tomorrow, we will see that there's also what we call cost of sales. Yes, it is inventory. So another last one I'm going to ask you is Stationers now buys stationery to use for the business. What is that? What is that? Stationery now is being bought for the stationery is bought to use for the business now. Stationery is bought now for the business. Yes. Well done, guys. Now this is bought for the business. Let me just see. Somebody, can I please ask a question? Yes, yes, you can ask.
Oh, okay. I thought when you buy something to sell it, for the business, if now you specialize in buying and selling something, it's not an asset, it will be an inventory. It only becomes an asset if now you buy to use it, for the business. And now, if now you use it for more than 12 months or something, it becomes an inventory. But now, if now you use it for less than 12 months, I think it's an expense or something.
Okay. Okay, I'll answer you on that. Thank you.
Okay.
So remember, I get what you're saying, Lehlohonolo. Inventory is an asset. And inventory is what? So remember, there's a difference between current asset and non-current asset. So current asset is within 12 months. Non-current asset is an asset longer than 12 months. So remember, inventory is an asset. Okay, no, Jerome is fine, it's fine. Lehlohonolo, do you get what I'm saying?
Yeah, yes, I do get you, man.
Yeah, remember, inventory is still also an asset. That's an asset.
Okay, but now if you buy it now and you use it for 12 months or less than 12 months, the difference between, can you please explain?
Okay, I will explain. So an asset that is used for 12 months or less is called a current asset. So that is also so important, guys, for you to understand that assets used for 12 months or less are current assets. Assets used for longer than 12 months are non-current asset. So basically, what's an example for a non-current asset? So a non-current asset will be your motor vehicle. So normally a motor vehicle useful life is longer than 12 months. A company will use that vehicle for longer than 12 months. So that will be a non-current asset that is longer than 12 months. So I don't know, are you with me on that, Lehlohonolo?
Yes, ma'am, I do understand. Thank you very much. I was so confused. Thank you.
Okay, so guys, my Wi-Fi is very slow. Jerome, no, it's fine. So I see Oscar saying equity. Yes. Oscar, income and expenses are part of equity. Yes, income and expenses both are part of equity. Yes, that is fine. So I'm gonna go back to learning unit. We were in learning unit 1. Learning unit 1. We're looking at page 13. So on page 13, is they talk about the accounting equation that should always balance. Take note the important points. So guys, page 13, this part, the bottom part of it, this is very, very important. Page 13. The accounting equation should always balance. Take note of the important points. A minimum of 2 accounts must be used. The equation must always remain in balance. A transaction can occur in a balance can occur on one side of the equation only. For example, an entity purchases equipment for cash. You will credit the asset bank and then debit asset. A debtor settles this account owed to the entity. You will credit the asset, debtors, control, and then debit the asset. So in this example, in page 13, let's go down, page 13. And also when doing the double entry principles, this is what you need to be able to apply. So with a show of hands, I want you guys to comment on the chat. Accounting equation, double entry principle, that will we covered on Saturday. Anybody who's having huge issues with this, just comment on the chat. Accounting equation, we went through it in detail, and also the double entry principle that we went through it in detail. Anybody else who's still struggling with that? The accounting, the double entry principle and the accounting equation. So that one we covered on Saturday. So I just want to know, is there anybody else who's having issues with that? So we can just quickly just go through that. Because learning unit 2, I just wanted to focus on internal documents, external documents. What are the internal documents? Okay, so Amanda is still confused. What are the internal documents? What are the external documents? And also the difference, for you to know the difference between cash and credit transactions. I think we should do maybe one example, okay? Let's see, offense. Okay, so guys, for you, offense and Amanda, I will do an example for you guys just for clarity, because I think other students are not commenting, but I think others are shy to comment, but others, I think they do understand. So before moving on to that, we're gonna look at 1.8. What is a contra account? Can somebody just comment on this? Their understanding on what is a contra account? Just somebody just comment, what is a contra account? Just comment on the chat. Somebody knows what's a contra account. I think that one, it will be more in detail when you do the general ledger, but I just want to see if you do understand what is a contra account. So basically on this learning unit is basically saying, as a general rule, we use opposite or contra account to describe the transaction. So in this transaction, the contra account is capital. The source of this increase to the bank account is capital. The owner invests in the business. If we were to describe each transaction occurring within the T account above bank, it will not adequately describe why our bank account increases or decreases. All transaction would just be listed as bank. Use the opposite to give a match. So basically, guys, I'm just gonna give you an example of what is a contra account. So if, for example, you bought owner of a business contributed money into the business, they've contributed about 50,000 into the business, and then that contribution was by EFT. So first of all, the owner contributed 50,000 by EFT. So already they are at that transaction. There is a lot involved with that, with just that transaction. Number one, you need to determine that transaction is what is the source document. The next step is so basically that one transaction, you need to apply what the accounting cycle on that one transaction. Number one, the transaction happened. Owner contributed 50,000 into the business. That's the first, the transaction happened. Number two, what is the source documents? The source documents for that would be if the owner gave in cash for that money. So there would be a receipt involved for that. And the other question is, or if it's an EFT proof of payment, that will be another form of source document. The next step is, where do we record this transaction? So two accounts are involved. They would be bank and capital. Okay, so we identify those two accounts, bank and capital. The other question is, what is the book of first entry? So remember, transaction, the next step, source document, we did say is either EFT or receipt. Number three, books of first entry. In what books of first entry would you record this transaction? This will go to your cash book receipt. The next step will be recording this in the general ledger. When you record this in the general ledger is when you record the individual account, which is, there's only two accounts involved, the bank and capital. It's bank and capital. So the question is, this amount of 50,000 came from the what book of first entry? Cash book receipt. So when you record in your GL, it will be bank, the date, the details on the GL would be what? So basically the contra, normally it would put the opposite. So it will be bank, on the bank account, it will be bank, the date, the details will be capital, comes from cash book receipt, the amount is 50,000. The other side of the entry in the general ledger would be capital, credit, the date, and then the description of that would be what? Would be bank. Comes from cash book receipt, the amount would be 50,000. So contra is normally puts, when you look at that account, which is bank, it must tell you what that amount comes from. So it will say bank, date, description is capital. Oh, there's a capital contribution that happened that for 50,000. It's sort of like, so a contra sort of like explains that account to say what happened in that account. So that's why it's so important to have a contra account. So in the general ledger, it's sort of like explaining what really that transaction is about. Somebody reading that transaction will be able to see what transaction is about. So guys, show of hands, do you understand what I just said? So basically, contra will come when you do your general ledger. So it's just describing where is that amount of money coming from. That amount of money in the bank account will be the date. That date, when was that amount paid into the bank? What that amount that came into the bank, what is that for? That's why we put the description capital, and then what is that amount coming from which book of first entry? Cash book receipt, and then the amount is 50,000. Then when you look at the individual account of capital, it will be credited the date that that 50,000 was contributed. The description will be bank. So the capital account is basically saying the date, the description is bank, the where is it coming from. So definitely there will be something called folio. It will say cash book receipt, the amount will be credited with 50,000. So it's also explaining to say this amount of 50,000 was paid, came by bank, was transferred in the bank account. So basically now I just explained just a brief of what is a contra account, but this will come in detail when we do the general ledger. So guys, do you get a brief of what is a contra account? So contra account is explaining to somebody looking at the ledger account to say that this amount comes from the bank. This amount is for capital that was paid by the owner, a capital contribution. So guys, now I'm gonna share. We're gonna be doing learning unit 2 now. So in learning unit 2, the main thing is understanding what is the double entry principle and the oh, Amanda, I now understand contra account. What is it for? Yes, that's good. So Amanda and I think Ofense, now I want you guys to understand what is the double entry principle and the accounting equation. So I'm gonna look at, guys, can you see I'm in page 3? Look at page 3, learning unit 2. Look at page 3. So I'm just looking at page 3 now. Page 3, can you see what I'm talking about? So every time now, when I talk about a transaction, it has to go through all the steps. This is the steps that every transaction. So basically, this is the accounting cycle. Can you see? So the main thing, the first step is what? Is transactions. The next point is source documents. The next step is books of first entry. The next step is ledger accounts. The next step is trial balance. The other one, the last part is this, the financial statements that I just showed you now. It was page 9 of learning unit 1, whereby I even showed you the example of how the financial statements look like. So the main objective of the company is getting to this point here. It's getting to this point, but for the company to get to this point, they would have gone through this. The first stage, transaction happens, source documents, books of first entry, ledger account, trial balance. This is the main objective. So now I just wanna go through, do an example of double entry system. So what is the double entry system? Double entry system implies that there are two sides or aspects to every business transaction. And this translates to, for every debit, there must be corresponding credit. So now I'm gonna go down, and then this will show you. Let's look at page 12. So in page 12, for you to be able to apply the double entry principle, step 1 to 4, you should have asked yourself these four questions. So guys, let's just go through 2.1. SA Africa deposited 100,000 as capital into the bank account of SA attorneys. Recognize the transaction in the accounting records using the 4-step. So basically, this is saying SA Africa deposited 100,000 as capital into the bank account of SA attorneys. So basically, number one, the first step. First step is saying identify accounts affected by the transactions. What are the accounts? What accounts are affected by the transaction? Step one, bank and capital. Step number two, will the transaction cause an increase or decrease in the accounts? Number two, the transaction will increase the bank and the transaction will increase capital. That is step number three. As number two. Step number three, classify the account. What type of account is that? Step number three, bank is asset and then capital is equity. That is step number three. Number four is step two plus step three equals the effect of step one. Let's see, step four is, what is step four? Debit asset, bank to increase it. So what I added on the Saturday class is step 4. The question is, what do you debit? Debit asset and which is bank to increase it in the general ledger, in the trial balance to you need to debit bank, and then credit equity capital to increase it in the general ledger and the trial balance. So let's just look. So basically, the double entry principle, always, when you do it, you need to be applying this. This is what you need to be applying. You need to be applying the 4 steps for you to understand the double entry system. So the question, I'm gonna give you an example that I want you to just answer. So for example, I said MMT Stationers buys and sells stationery. So MMT Stationers now pays a salary to one of its employees, 5,000 per month. So my question is, identify the accounts affected. So basically that salary was paid by EFT for 5,000 Rand. So that employee works for MMT Stationers. So that employee was paid a salary of 5,000 by EFT. So my question is, please identify the accounts affected. Will the transaction cause an increase or decrease in the account? Classify the account. And also step number the 4 is, please, will the account be debited or credited in the general ledger and the trial balance? So that's the question I'm having now is, please guys comment on the chat. This is an example I'm giving you. MM Stationers pays one of the employee 5,000 by EFT. So I need you to identify the accounts affected by the transaction. I need you to do step 2. What are the accounts affected? So a salary, MM Stationers paid one of their employees a salary of 5,000 by EFT. So in step, you need to do, say, step 1, 2 accounts. These are the 2 accounts. Step number 2, will the transaction cause an increase or decrease in the account? Number 3, classify the account. Is it an asset, liability, income, and number 4, will this account be debited or credited in the general ledger and the trial balance? So step number 1, bank and salaries. Step number 1, you're saying bank and salaries. Bank and expense, okay. Okay, Nonhlanhla is saying bank and salaries. Lehlonolo is saying bank and salaries. And then I just want to hear from Amanda, bank and expense. Amanda on offense. Those are the two people who said they're not sure of the double entry system, but I'm not seeing their comments here. Offense and Amanda. Oh, okay. All right. No, Amanda, no. It's fine. It's fine. But we want mostly because you two are the ones who a bit of struggling with this. I just needed for you to also just participate. Bank and expenses. Okay, account salaries and bank, increase salaries. Okay, so offense is saying salaries and bank, increase salaries, account, increase, decrease bank. Accounts affects expense, an asset, okay. And then bank is credited, and so I can see overall everybody step 1. Let's just go through it. I'm just happy with most of your responses. Your responses are quite, yeah. So let's, yes, bank credited and asset. So I'm just happy with your responses because the first one, identify the accounts. Yes, bank and expense, bank and salaries. Yes, because salaries was paid. And then will the transaction cause an increase or decrease in the account? Bank, because money is going out of the bank account, will decrease. Expense will also increase because the company is increasing. This is increasing by paying, and so the expenses are increasing of the company. So it's going to be bank and asset decreasing, and bank and asset decreasing, and then expense is increasing. Classify the account. What type of account? So salaries is an expense and bank is an asset. So, and then will you debit or credit to those accounts? Bank is an asset, and when an asset decreases, you credit. Expense, salaries is an expense, and when an expense decreases, you debit the expense. No. I'm gonna repeat that. So you're gonna debit, you're gonna credit bank. Credit bank because it's an asset, and when an asset decrease, you credit it. You're gonna debit an expense. When an expense increase, you debit it. So the two accounts are gonna be debited in the bank is gonna be credited in the general ledger and trial balance, and then expense is gonna be debited in the general ledger and the trial balance. Yes, offense, the bank credited, and then the expense, yes, and then the expenses debited. Yes, no, they are important, the signs. Yes, the signs are important. The signs are important. So, I see bank credited expense. Yes. So, I'm not sure how Amanda is, but how do you feel, guys? We just did this one example. With the other ones, you repeat the same principle. So remember again, with the accounting course or subject, it's practice, practice, practice for you to be perfect. Practice, practice, practice with an accounting class. So now I'm gonna be, we're gonna be doing the accounting equation. So the accounting equation of it, the same example. Can you see? Look at we're gonna be looking at the same example in page 12. The same example. Can you see? Plus the accounting equation is here. Asset equals to equity plus liability. Plus 100,000 equals to plus 100,000. And then plus 0, the net effect of liabilities, there's nothing. Can you see that your accounting equation balances? Can you see that this accounting equation, guys, balances? Plus, the signs here, plus, minus, are so important when you do the accounting equation. They are very, very important. And also make note, when you do the accounting equation, I'm slightly getting it. Credit, bank, debit, asset. I'm also taking notes. So yes, that's good. So remember now, Nonta, Amanda, it's credit, bank, and debit, expense, not asset, debit, expense. So now when we do the accounting equation, guys, remember the accounting equation, this must always balance, must always balance. Can you see? Asset plus 100,000 equals to equity plus 100,000. Liability, there's nothing, there's 0. So it's plus 100,000 equals to plus 100,000. So this balances. Can you see the accounting equation? So when you do the accounting equation, always remember your expenses will always decrease the equity, and then your income will always increase your equity. That's when you do your accounting equation. So you need to make note that when you do the accounting equation, when you have a transaction, and in that transaction, there is an expense, that expense will decrease equity and income will increase equity. So in this example that we did, that I just did now, when I said Stationers paid salaries of 5,000 to one of his employees by EFT. How will this affect the accounting equation? How will this example affect the accounting equation? So that 5,000, how will it affect the accounting equation? That 5,000. So remember, Stationers paid a salary of 5,000 to one of his employees. So my question is, how will this affect the accounting equation? What will be the entries so that your equation balances? With regards to the signs, when there's an increase, you make it a plus, and when there's a decrease, it's a minus. Yes, offense. So in this case, Stationery paid one of its employees 5,000 Rand as salary by EFT. So now you need to record the accounting equation for that transaction. What will be the entries there? So basically now, offense, look at this examples that we're looking at. Because bank is increasing, we said plus 100,000. And then because we said capital equity is increasing, we said plus 100,000. Can you see? Because asset bank is increasing, money came into the business, plus 100,000. Equity capital is increasing, plus 100,000. So these signs are important. Plus is saying this 100,000 is increasing, and then plus 100,000 is saying capital is increasing equity. Plus 100,000 is saying plus 100,000 is saying bank is an asset and assets are increasing. Plus 100,000 here is saying. So make sure, especially debit bank to pay salaries by EFT, no show. So basically, guys, when you do the accounting equation, remember one thing: your equation needs to always balance. So when we look at this equation here, can you look at page 12, learning unit 2? Can you see the equation balances? Plus 100,000 equals to plus 100,000, and then liabilities, there's nothing, plus 0. Can you see that there's nothing on your liabilities? Can you see that this transaction balances? So the main thing of this accounting equation is it needs to balance. So can you see plus 100,000 equals to plus 100,000, and then plus liability, there's nothing, is 0. So is asset plus 100,000 equals to equity plus 100,000, the effect plus 0 liabilities. So can you see that this equation balances? It must always balance. So now let's, because I can see everybody's is it's sort of like struggling with the accounting equation. Let's do another example. Example, we on page 13. Let's do page 13. Let's go to page 13. So when we look at page 13, let's look at page 13. I'm going to be looking at page 13 now. On page 13, it says SA attorneys purchased computer equipment and paid 85,000 for the equipment. Recognize the transaction in the accounting records by using the 4-step. So remember now, SA attorneys purchased computer equipment, 85,000. So 2 accounts are involved, both are assets. Can you see? Both are assets, bank and computer equipment. Both bank is decreasing and the asset is increasing. And then they are both asset, and you're gonna debit asset computer equipment, and you're gonna credit bank. Both you're gonna debit asset office equipment in the general ledger and trial balance, and you're gonna credit asset bank in the general ledger and trial balance. Then the accounting equation. Let's look at the accounting equation. Before, when you look at this accounting equation, look at step 2. If you're confused, look at step 2. Step 2 will assist you. Look at step 2. Step 2 is saying transaction will increase computer equipment. Then when you look at the accounting equation, plus 85,000 computer equipment. Then step 2 is also saying transaction will decrease the bank. Can you see? Minus 85,000, that is the bank. The equation balances. Why am I saying your equation balances? 85,000 minus 85,000, there's a 0 effect, equals to equity, there's nothing, liability, there's nothing. Can you see that this transaction is balancing? So remember that when you do the accounting equation, the equation needs to balance. The equation needs to balance. So guys, I'm asking the same another question, the same question. If your MM Stationery paid one of its employees 5,000 by EFT, what is the effect of the accounting equation? What is the effect of the accounting equation? What is the effect of the accounting equation? So please make a note of this, write it down somewhere. Write it down somewhere. Expenses will always decrease your equity when you do the accounting equation. Income will always increase your equity when you do the accounting equation. Make note of that when you do the accounting equation. So basically, it's a hint I'm giving you in doing this transaction. Expenses will always decrease equity when you do accounting equation. Income will always increase equity when you do the accounting equation. Please make a note of that. So the transaction that we are talking about now, Stationery paying salary of 5,000 by EFT. What is the effect of the accounting equation? Remember, accounting equation needs to balance. It always needs to balance. So can you see here, plus 5,000 minus, can you see? And also when you answer, put those signs. Can you see here, plus 85,000 minus 85,000 under assets? And then effect here, there is nothing. So non-Nhlanhla, I can see non-Nhlanhla, it's only one-sided. I need your equation to balance. I need your equation to balance. So M Khoza is saying bank, debit bank minus 5,000, and then credit bank 5,000. Okay, non-Nhlanhla is saying equity, debit, salaries, 4,000, and then minus 5,000. So you credit bank by 5,000 and you debit expense. So I want to see the sign. Remember, when you do the accounting equation, the plus, the minus are very important. The plus, the minus are very important. So in this let's see. So in this example I'm giving you, asset bank will be minus 5,000. Equity salaries will be minus 5,000. That is the answer. Stationery paid salaries of 5,000 rand. Salary is an expense and is increasing, so offense is saying salaries. Offense is saying salary is an expense as in is increasing, so you plus 5,000. EFT is cash, which is an asset, is decreasing. So offense, can you see that your equation is not balancing? M Khoza, yes, well done. your equation. And then M cosa, I think you made a mistake. It's the signs credit bank and debit salaries, which is equity. Your signs are incorrect. So basically, salaries, guys, salaries will be minus 5,000 under equity. Inc will be minus 5,000 under assets. And bank will be minus 5,000. So so guys, please, I'm gonna say this. Please make a note of this. When you do accounting equation, expenses will always decrease equity. Make a note of it, write it somewhere, because I can see that a lot of you are struggling now with the accounting equation. When you do, please make a note of what I'm saying now. Write it down, put a note on it somewhere. When you do the accounting equation, expenses will always decrease equity. Income will always increase equity. Please, I'm going to say this. Please make a note of it. Please make a note of what I'm saying now. When you do accounting equations, an expense will decrease owner's equity, and the asset wealth and the income will increase owner's equity. Let me give you an example of what I'm saying. If now Stationery buys Stationery pays a salary to one of its employees, to one of offense equity. Yes, Nontantla. Yes. So if I'm gonna give you an example of what I'm saying when I say expense will always decrease owner's equity. This is an example I'm talking about. When a company Stationery now pays salary to its employee for 5,000. Bank will decrease and salaries will increase. When a salary increases, it will decrease owner's equity. I'm going to repeat that. When an example of why I'm saying when you do accounting equation, expense will always decrease owner's the equity. For example, salaries are getting paid. So Stationery pays one of its employees 5,000 as salary. Salary is an expense. So the two accounts that are involved here is bank and salaries. Salaries will increase by 5,000. Bank will decrease by 5,000. Every time an expense is increasing, you're debiting that expense. And when you do the accounting equation, when an expense increases, it decreases owner's equity. I'm going to repeat that again. When Stationery, I'm doing an example of why I'm saying an expense will decrease owner's equity. So in this scenario, this example that I'm giving you is when a company, Stationery, is paying salary to one of its employees for 5,000, bank is decreasing because money is going out. But the next part is the expense. The expense is salaries is increasing. But when you do accounting equation, when an expense increase, it decreases owner's equity. That is why I'm saying the expense will decrease owner's equity. The next example is why I'm saying income will increase equity. So when now customers buy stationery from Stationers, they buy stationery, let's say for example, because Stationers buys and sells stationery. If Stationery buys and sells stationery, now customer comes and buys stationery for cash for 6,000 Rand. That is money being received by Stationers. So that will be what? Bank and income. So there's money coming into Stationers account because the customer has paid 6,000 Rand for stationery. In that example, two accounts are involved, bank and income. Bank and income. Bank is what is increasing because money is coming to the bank account. Income is increasing because there is more income coming to the business. So how does that affect the accounting equation? Bank will be plus bank 6,000, and then asset equity will be plus 6,000, also increasing. So that's why I'm saying income, when it's increasing, it will increase equity. I don't know if that is, do you understand? Just comment, guys, if you understand what I'm saying. Because now I'm getting worried that people are getting confused on the accounting equation. I need you to comment on the chat. I'm worried about you guys understanding the accounting equation. I'm getting worried. So remember, the accounting equation needs to always balance. It needs to always balance. Why am I saying it needs to balance? Look at page 13. Can you see? This balances plus 85,000 minus 85,000. That balances. Then equity here, it's 0. Liability is 0. Let me go up. Can you see there? This balances plus 100,000 plus equity here, 100,000. If you're getting confused, look at step 2. Look at step 2. Step 2, I think, will make you understand more. Step 2 will make you understand more. Step 2. But some exercises do not like a mini quiz for practice. Would be. Let me see. Will this be different if we were doing the double entry system? So when you do the double entry system of Fancy, so remember the double entry system, we follow this. So the double entry system, let's look at the double entry system. So the double entry system, remember, follows the step. This is the accounting, the double entry system, identifying this. But if you feel this is confusing, whatever you're going to do in the accounting equation will be the same as step 2 of the double entry principle. So if you feel you don't understand the accounting equation, look at step 2. Whatever you've done in step 2, when you do the double entry system, it will be the same thing when you do the accounting equation. If you feel this is confusing you. Yes, Amanda, this must always balance. However, I'm still not 100% confident. I will practice some example, ma'am. I'm taking notes. Please, please, please. This is a practice thing. But repetition, when you repeat, but the main thing is this, your equation must always balance your equation. And then offense, your question, will this be different if we were doing the double entry system? Look at the double entry system. Can you see it talks about the 4 steps, but when you look at step 2 and then you look at step 2, it says, well, the transaction costs increase or decrease in the account, and then account is increasing. And then you look at the accounting equation, it's the same thing. It's the same thing. Well, the transaction increase or decrease in the account. So step 2, look at step 2 now on this example 2.1. Can you see the step 2? Step 2 is saying the transaction will increase the bank account. Look at accounting equation plus 100,000. Step 2 again, the transaction will increase capital. Can you see? Plus 100,000. Can you see? Let's look at the next example. Step 2 again. Transaction will increase computer equipment. Plus 85,000 computer equipment. The transaction will decrease bank account. Minus 85,000 bank account. So if you feel this is confusing, step 2 of the double entry principle will be the same as your accounting equation offense. I'm not sure if that is clear on you. That is clear for you. What I just explained now. Please comment if
Hello, ma'am.
Hello.
Yeah. Will I be correct to say now that since now the company is paying one of its employees' salary, and now you can't increase the expenses because of now it increases on the debit side expenses. You have to go to the equity because of now you take money out of the company. So now, since now you take money out of the company, you have to credit. You have to debit the equity. Will I be correct to say that?
So basically now you're talking about the accounting equation.
Yes, ma'am.
So in the accounting equation, remember in the accounting equation, expenses decrease equity. So basically, credit bank, debit, expense, which is salaries. So when you debit the expense is what is increasing. And when an expense increases, it decreases equity.
So now you can't just write the fact that you paid your employees. It will affect expenses. It will have to affect and equity. That's what you write.
So when you
because
do
of money
that,
comes out of the bank, out of the company, it affects the equity. Okay.
So remember now, again, equity is affected by these accounts: income, expenses, capital, and drawings. That is the only accounts that will affect your equity. Income, expenses.
Okay, so now you made an example about, I think it was salaries. You
Yes.
said now that we receive money from something, so from someone else, you know, they pay us. As in, I think it was sales or something. You just
Oh,
spoke about sales. So now it will also affect equity as well.
yes, yes, yes.
So now it means now that we no longer consider, we know that it's sales, but now we say that it credit the equity. It will affect bank and equity when they pay some, when we work, and or when we make sales or something. It will
Yes.
increase. Okay.
So, Lefronolo, I'll just want to clarify this and just um, um, I understand what you're talking about. So I made two examples. So the first one was Stationery, and expense salaries was paid for 5,000 rand out of the business account, 5,000 rand. So that, because the expense is increasing, and when an expense increase, you debit. For the fact that that expense is increasing, the effect of it on equity will decrease equity, that expense. So, Lehlohonolo, I was saying that when the expense now, when stationers pays an expense for 5,000, pays salaries for 5,000 by EFT, how does that affect your accounting equation? Number one, bank decreases because money goes out. So it's going to be minus 5,000. Then, because the expense is increasing, the effect of the expense increasing will decrease your equity. It will be minus 5,000. So I'm going to make another example whereby Stationery receives, customer buys stationery for 6,000 rand, and the customer pays by EFT, that's 6,000 rand. Two accounts are involved, which is bank and income. So bank is increasing because money is coming into your account, and then the next account is what? Is income. Income is increasing, and when income is increasing, it will increase your equity. Your equity will be increased by that income. So
Okay. So ma'am, on your accounting equation, you no longer include the income. You include equity
yes,
and asset,
yes, yes,
bank and equity.
yes. Yes.
Okay.
Look,
Okay.
so look at the accounting. Let's look at the accounting equation. Can you see the accounting equation is assets equals to equity plus liabilities? And I'm saying to you, equity gets affected by income, expenses, capital, and drawings. So can you see the headings? The headings of this accounting equation is only assets, it's only equity, and liabilities. And at the end of the day, your equation needs to what? To balance. It needs to balance at the end of the day. It needs to balance. Offense understood, ma'am. So what goes out of business is a decrease, and which comes to the business is an increase. Yes, yes. Because offense is saying, I will also go practice some more. May we please do example 2.17 in page 17. Let's see, page 17, page 17. Page 2.17. Let's see. This is the accounting equation. So, offense, yes, let's look at example 2.17, which is the accounting equation. So, number 2 is saying owner Mr. South made a capital contribution to the business, being 5,000 cash and equipment with a owner make capital contribution of 5,000 cash, and also owner contributed equipment with a market value of 2,000 rand. So number 2, I need you to understand that an owner contributed money and also an asset. Number 2, owner contributed what? Money cash, which is 5,000, and owner also contributed what to the business? Also contributed a equipment with a market value of 2,000. So how will this affect the accounting equation? So because the owner has contributed 5,000 plus 2,000, your capital, initially they have contributed 5,000 and 2,000. So 5,000 is the money and 2,000 is the asset. So basically now on number 2, can you see that plus capital increase plus 5,000 increase, the equipment, because the owner contributed equipment, increases by 2,000. Bank, because money came in, increased by 5,000. Can you see, guys? Do you understand the first transaction, how it affects owner's equity? So number 2, can you see that the owner contributed cash plus equipment? So there's an additional money coming into the business by cash 5,000, and there's a new equipment that's coming in for 2,000. Do you understand the effect of this? Okay, so let's do number 5. Number 5 transaction. Let's do transaction number 5. Purchased trading inventory with a debit card for 5,000 for 1,000 rand. So the business SA Products bought trading inventory with a debit card by 1,000 rand. So they've bought a trading inventory. This is what they bought. So for 1,000 rand. So let's just see number 5. So bank decrease with 1,000 rand, and then so in number 2, thus they take it as purchases. So purchases is a form of an expense. So they're not taking this as an asset, as a trading stock. So in this example, I can see that they're taking this as an expense. Why I'm saying they're taking it as an expense? Can you see that here? And they made a note about it. Can you see what I'm saying? They took it as an expense. That's why it's a minus 1,000 rand. Can you see? So this is what I said to you. An expense will always decrease owner's equity. So can you see that bank, because they've purchased trading inventory, bank decreased by 1,000 rand, and then your purchases will decrease by 1,000 rand. The number 9, sold inventory for cash for 2,500. So if the business has sold, meaning there's income coming into the company. So number 9 is bank, money is coming in plus 2,500, and then sales is an income, and when an income increase, it will increase owner's equity. So I want you to look at this. Can you see that the transaction always are balancing? Can you see number 2 plus 7,000, 2,000 plus 500 plus 7,000 plus 5,000 is 7,000. Look at transaction number 5. Minus 1,000 equals to minus 1,000, and liabilities is 0. The effect is, let's see. And why is it not taken as an asset? So it's not taken as an asset because that's how they decided to do it for this exercise. So for me, I would have taken it as inventory. So for me, this 1,000 rand, I would have taken it as inventory. But I can see that this, in this example, they're taking it as cost of sales. That is why Oscar. So for me, if I was doing it, they said bought trading inventory, I would take it as an asset. But in this example, I can see that they're taking it as cost of sales. So they're taking it thus as an expense. So yeah. Let's just look at the next example, number 12. Let's look at transaction number 12. Purchase trading inventory on credit 600. Look at number 12. So number 12, I can see also they're taking it as an expense. So number 12, purchase trading inventory on credit for 600. So because it's on credit, it won't affect the bank. So the entries that are there is purchases and accounts payable. So because this, why is it not bank? Because it's on credit. It will affect your accounts payable. So in this case, let's see number 12. Let's see number 12. Let's look at number 12. Purchase trading inventory on credit. You know what? Number 12, I'm picking up something. Can you see, guys? Number 12, this is not balancing. Oh, no, it is balancing. Oh, I thought it didn't. Can you see that? Yeah, it is balancing. Remember, asset is 0 and then minus 600 plus 600 is 0. Yes, it's balancing. So it's minus the expense because they bought trading inventory, and then plus accounts payable because your liabilities are increasing. So let's look at number 19. Paid monthly insurance, 1,000 Rand. So number 19, can you see that money is going out, minus 1,000 Rand? And then insurance is an expense. And when an expense increase, it will decrease what? Equity, your owner's equity. And then let's look at 23. Sold inventory on credit. Sold inventory on credit, that is number 23. Accounts receivable increases by 7,000, and your sales, its income is increasing at 7,000 Rand. That's number 23. Number 27 is purchased equipment by EFT for 3,000. Money is going out of the business, and we acquire an asset. So it's going to be minus 3,000 and then plus equipment. We acquiring an asset. So the effect is minus 3,000 plus 3,000 is 0. Can you see that? And then number 29 is paid wages or cash for 800. Can you see? This is the example I've been giving you with Stationers. Minus 8,000. Bank money wages was paid, and then minus 8,000 because when an expense increase, it will decrease your owner's equity. Number 10, let's look. Paid water and electricity account 1,100. Can you see 1,100? Bank is decreasing, money is going out. Water and electricity is an expense, and when an expense decrease, it will decrease your owner's equity. Minus 1,000 Rand. Then the equation balances. And then after this, guys, I need you to make to be aware of the two scenarios I'm going to show you. Look at transaction number 9. Look at transaction number 23. What is the difference between those two transactions? Look at transaction number 9. Look at transaction number 23. What is the difference? Yes, the one is cash, the one is 23. I just want for you to know the difference between the two. When something is sold by cash, it will affect the bank. When something is sold on credit, it will affect your trade receivables, your debtors control. Can you see? So why I'm raising that because this is cash and credit transaction. So the cash transaction will affect your bank, and the credit one will affect your accounts receivable. Yes, the cash. So the transaction by cash will affect your bank, and the transaction by credit will affect your accounts receivable. So money is received by the business, but the other one is they received it by cash. The other one, they received it not now. So they haven't received it as yet. So that money, that other entry of that will be accounts receivable. So both this transaction will affect your sales, will affect your income. But the other side of it, it will differ. So it will be credit income if it's bought in cash, and then debit bank. If it's bought on credit, it will be credit income and then debit accounts receivable. And also look at transaction number. I want you to look at the difference between transaction number, let's see, transaction number 5 and transaction number 12. Look at transaction 5 and 12. Can you see transaction 5 and 12 is also purchased debit card, 1,000 Rand, which is cash, and also 12 is purchased on credit. So when a company buys by debit card or by cash, it will always be affect your bank. It will be debit your expense, or maybe I don't know if they bought an asset and then credit bank. But in transaction number 12, because that was in credit, it will be debit the expense and credit accounts payable. Accounts payable. So look, can you see what I'm showing you? It's either things the company will sell by cash or credit, or the company will buy by cash or credit. If it's always by cash, buying or selling, it will affect the bank. If they are selling something by on credit, it will affect accounts receivable. If they are buying on credit, it will affect your accounts payable. But if they buy or sell by cash or debit card, it will affect your bank account. If the company is selling their goods on credit, it will be, instead of, because they're not buying and they're not selling by cash, they're selling on credit, it will affect your accounts receivable. If they are buying on credit, it will affect your accounts payable. Sorry, ma'am. Is the accounts receivable and debtors control? Yes, it is. It is the same thing. Yes. Yes, Oscar, it's the same thing. Yes, it's the same thing. Yes, it's the same thing. Yes, it's the same thing. Offense, are you happy with the counting equation? Guys?
Hello. Hello, ma'am.
Hello. I think there's two of you who unmuted. Rashida. Oh, okay. Lehlohonolo.
Okay, ma'am. Can I please ask you, with there's a question I have with regard to this drawings. Well, drawings,
Yes.
does it have any effect on equity?
Yes. Yes, it does.
Okay,
Yes, it does.
meaning that income, expense, and drawings, they have effect on equity.
Yes, and capital.
It applies the same. They affect
capital.
in capital as well. And capital, okay.
Yes.
So they do affect when drawings increases. They decrease. You debit your equity.
Yes, it also decreases your equity.
Okay,
So take it this way. Your income and your capital increases equity. Your drawings and expenses decrease your equity.
okay. Thank you, ma'am.
Guys, are we clear with accounting equation? Remember the accounting equation also with the double entry principle. It wants practice, practice, practice. It wants practice, practice, practice. Guys, do you know the difference between internal source document and external source document? What is the difference between the two? Internal source documents and external source documents. What is the difference? What is the difference between internal and external source documents? So basically, the internal source documents are the source documents that the company would generate initially, will come from the company. Let's say, for example, an internal source document would be so an internal source document is when a company sells to its customer. So when it sells to its customers, the customer normally gets the original invoice, and what is left is a duplicate invoice. So when Stationers buys sells stationery for 6,000 to its customers, it will issue an original tax invoice to the customer, and it will retain the duplicate of the invoice in the company. So that's an example of an internal source document. So it's a source document that are prepared by the entity itself to record transactions with external clients. So what are external source documents? So external source documents are documents prepared by the other party of the transaction and received by the business as proof of transaction did take place. So for example, you go buy office equipment, or you go buy, the company goes and buys an asset. They will get an invoice from where they bought the asset. So that invoice is called an external source document. That is called an external source document. So guys, please also read up on this and make sure you understand your internal source document and your external source document. Your internal source documents are the source documents prepared by the entity itself to record transactional external clients. And then the external source documents are the documents prepared by other party to the transaction and received by the business as proof that the transaction did take place. And the other thing is, who can explain to me what is a cash transaction? What is a cash? What is a cash transaction? Who can just explain to me what is, if somebody asks you, what is a cash transaction? What is a cash transaction? A cash transaction is an immediate payment. Immediate payment paid. So it's either your customer pays you immediately or you pay your supplier. So that is an immediate payment. That is a cash transaction. So overall, guys, any questions before we close? Any problems with learning unit 1 and 2? Any more questions? Because tomorrow we'll be doing learning unit 3. So today it was just 1 and 2. Any issues, any problems? So guys, if there's everybody's understanding and there's no issues, then we'll meet tomorrow